Good afternoon, everyone, and welcome to Park City Credit Union's second annual Northwoods Financial Summit. Thank you for taking the time to attend this virtual session. My name is Lisa Krokramer. I'm a member of the marketing team at Park City, and I'm excited to be your moderator for this session. Before our presenters, Kurt and Ryan, begin, we have a few housekeeping items to share. During the presentation, we will have all participants in a listen-only mode. This is to reduce any feedback or background noise. We will have a Q&A at the end of the session. At that point, you can unmute yourself and ask your questions. However, feel free to leave your questions in the chat at any point during the presentation, and we can address them when there is time. For those unfamiliar with WebEx, we have provided a key on the screen that references a few helpful features. You can mute and unmute yourself by clicking on the microphone icon. Clicking on the chat bubble will bring up the chat box where you can leave your questions and comments for our two presenters. Clicking on the person icon will bring up the participants panel. There you can click on the raise hand signal to signal that you would like to speak and unmute yourself. As a reminder, this session is being recorded. We will send the link to all registered attendees next week when all sessions are completed. Included in that email, we will have a survey, a link to a survey, for your feedback on the summit. As a thank you for filling out the survey, you will be entered to win a prize. All right, I am excited to welcome back Kurt and Ryan. They spoke in our afternoon session earlier today, and we're excited to have them back for our session on retirement.
Thank you.
Thank you. You're very welcome. And I'll give them a brief introduction. Kurt Powers and Ryan Powers are with Park City Investment Center. Park City Credit Union has partnered with this team for over 10 years. They have the same philosophy and values as we do at Park City Credit Union, which makes us great partners. So without further ado, Kurt and Ryan, I'll let you take it over again.
Sweet. Thanks again, Lisa. I need to disclose that Park City Credit Union's Investment Center offers its securities through Packer Land Brokerage Services, an unaffiliated entity and a member of FINRA and SIPC. Non-credit union products and securities are issued by, are not insured by the National Credit Union Association or any other federal government agency. They are not deposits of, obligations of, or guaranteed by Park City Credit Union or the Park City Credit Union Investment Center, and investments are subject to investment risk, including possible loss of principal amount invested. So, the home stretch. If you've ever watched a track race, basically on TV, you see that as they get down across that last corner, it's called the home stretch. And during the home stretch is a time that you definitely don't want to stumble. You want to get into the finish line safe and sound. And so that final decade before retiring is the home stretch. And we help members and people in the communities of Park City Credit Union with planning for their retirement home stretch. So hopefully there aren't too many or any stumbles.
So 7 things you need to do in the decade before you retire. Determine when the time is right, take aim at your retirement target, maximize your nest egg, get a portfolio checkup, create a Social Security strategy, build a retirement income stream, and look beyond the money. We'll be hitting on all of these throughout the presentation as we go. So determine when the time is right.
So Otto von Bismarck is called the...
I went back on accident, sorry.
Okay.
I'll get it. I got it. Go ahead.
Yep.
Sorry. Here we go. And we'll just start. We'll start back over. Sorry about this, everyone.
Otto von Bismarck is called the grandfather of retirement. He was the Chancellor of Germany in the 1800s, and he basically set up that the state pension was available in the 1800s for anybody once they reached the age of 70. But actually not too many people were able to accumulate or take advantage of their pension. Why was this? Because basically the life expectancy in the 1800s was the age of 43. So people died long before they would ever get their pension. What's important about that is that Social Security was introduced in 1935 and defined as age 65 being the retirement age. And so right now you might know that you can at age 62 can start to take retirement, and age 67 it's full retirement, and age 70 it's the maximum. But the difference is this was never set up to be taken out because the life expectancy was in the age 50s while you were in the 1930s. And now we're living much longer to be in our 80s, 90s, even 100 years old. So now we do need to live off of Social Security, but it was not set up for that. So at what age do you think you're going to retire? Age 55, 58, 60s, 65? Well, one of the keys there is that basically poor health and unemployment can be a difficult thing, and government insurance kicks in at the age of 65, so there's some things to consider there. Actually, the half of the people retire in their early 60s. 46% of the country retires between the age of 61 and 65. We need to count differently if you are a single person or you're married, whereas if you're married and you might have got married at age 24 and the wife is 22, the husband's 24, when they hit age 65 for the man, the wife might be age 63. When it goes up and the man is 83 and the wife might be age 81 or vice versa, those are things to be affected or to be accounted for. But then also, women do outlive us men by 5 years on average. So you need to account whether, first of all, there's an age difference, but then luckily the women do live longer, so that needs to be accounted for in retirement planning.
So important ages for retirement. At age 50, you can begin catching up on your contributions into your 401k or retirement plan. Essentially, that means that you're able to add more money to your plan. At age 59 and a half, we'll jump ahead a little bit here. Well, I guess 55 we'll talk about. You may be eligible, depending on your employer, for early distributions from your current employer plan. So you might be able to have that vested to put into a self-directed IRA. At 59 and a half, your full retirement age for qualified plans, you're able to access your retirement money at that point without penalty. At 62, your Social Security benefits start kicking in, so you're eligible for that. Then jumping ahead a little bit here, at 72, what previously was 70 and a half is now when you're able to take out your required minimum distributions or your RMDs from your retirement plans. So next, take aim at your retirement target.
So, rule of thumb one, you should be considering saving enough to generate 70 to 90% of the money in retirement of what you had as pre-retirement income. But I am going to add a little bit there. There is a range of 70 to 90%, but in Merrill, Wisconsin here, we see plenty of folks who retire with no debt. They've paid off the house, they've paid off their cars, they don't have any credit cards, and those people might not need 70% of what they were earning when they were working because they basically don't have any expenses any longer, and of the money they have, they're not paying into a 401k any longer. Now, on the other hand, we run into some spenders who retire and they still have a mortgage on the house. They have a mortgage on the hunting cottage or the vacation property. They have jet skis and a water boat with a loan on those up at that summer home. They have credit cards and they have a brand new pickup truck to pull that ski boat or the fishing boat or the jet skis up there. And those people do need the 90%. Some of them even need 100 or 110% of what they had. So again, we're going off of guidelines here, but at our investment center, we've seen different things that are outside of the guidelines, and we are flexible for that. So some costs that may go up in retirement might be a mortgage, transportation, clothing, and food. Some other things that might be higher or worse than the regular cost of living raises are healthcare is much more expensive as you get older. Travel, utilities stay the same or go up, and maintenance for your home as it gets older. Some costs that go away is Social Security taxes and the money that you have to put away for retirement if you're already retired. So again, that's how we look at that 70 to 90% range, but again, everybody is different. So this is a teaching percentage, but we might have some numbers below or higher to that depending on each individual situation. Rule of thumb number 2 is save a multiple of your salary based on your age. Why might that be different? If you are retiring younger, you might need to be having more because you're going to live longer. If you retire closer to that age 70, you might not need as much saved as if you were going to retire at the age of 60. How much do you need to have saved at various ages? So again, if your salary was $100,000, you might need somewhere between $600 and $800. Again, it's not as much if you're age 30 because you have quite a bit longer to be saving some more. But if you're already into age 60, 65, you might need to be having 8 to 10 times, 12 times more of what you've been earning saved away. And rule of thumb number 3, save enough to generate a 4% withdrawal rate. Again, a general rule of thumb is that 4% of your retirement monies is what you should be living off of when you retire. But again, depending on expenses and how much you want to travel, how active you want to be in retirement, and how young you are, we've seen people take 2% out. We've seen people spend 6 or 8%. So rule of thumb's 4. We're flexible with different people. What do you need in order to withdraw that 4%? So if you're looking to have $25,000 of income, that's going to come from $545,000 if you're earning 1.5% in a savings account. If you need $50,000, you would need $1 million put away. If you want $100,000 a year in retirement, you again might have to have $2.1 million saved for a 20-year retirement. If you're earning more on that money, if you have it in a place where you're earning 5%, it reduces the dollar amount from $545 to $391 for the $25,000 a year, $782,000 instead of $1 million for the $50,000 a year income, and only $1.5 million instead of $2.1 if you were to be withdrawing $100,000 a year.
So number 3, maximize your nest egg.
So take advantage of work-sponsored plans. Basically, if you're working, you can put a maximum of $19,500 into a retirement plan, and an employer match can be up to $4,500. Page. Going further than that, if you're age 50 and older, you can be putting money into a separate IRA or a Roth IRA, and that can be raised up to $6,500 per year. And another part of this is that you can have a spouse put money into their own IRA also, so you can find monies different ways. It can be a Roth IRA, it can be an individual IRA, it can be the 401k, and a spouse does not need to be working for them to be also adding money into a retirement plan. Go ahead, keep going. So, how tax-advantaged retirement savings can add up? The hypothetical growth of a retirement savings plan with a 6% return. $44,000 times 15 years at a 6% return comes out to be quite a large amount of money, $1.063 million. So again, if you have money growing without taxes coming out of it, you can get a decent return.
So number 4, get a portfolio checkup. This is especially important right now, given the circumstances of COVID-19. Some people may have been forced to leave their job, unfortunately losing a job, or we've met with some people who have kind of had their hand forced into retiring early. Now would be a very good time to come in and get a second opinion or a look over your current financial portfolio, given the circumstances. Oh. So how today's jobs complicate retirement planning. An average worker switches jobs 12 times. 71% of jobs offer 401k or similar plans, and 60% of plans have automatic enrollment.
So, perception versus reality of your asset income. So you might have a current retirement plan that's 40% bonds, 60% stocks. But if you have different jobs, those might have been out of whack, where it started at a 40-60, but the stocks grew much more than the bonds. You might have more money invested in the market than you thought. So we often go ahead and take the monies that are in these retirement plans that can be drawing different amounts and consolidate them into one, so that we can be setting up and making sure that you have control of what's going on in your accounts. What if you have too much invested in stocks? Well, this is showing 1999, if there was $900,000 in stocks and it all stayed in the light blue or the stock market line, we lost 50% of market money from the year 2000 to 2002. So the $900,000 would have dipped down below $550,000. But if it was put into a 50-50 stock bond mix, you're seeing that the dark blue line didn't lose nearly as much money and then more quickly came back up to grow above the $900,000 and to hit a magic $1 million amount. But what is the problem if you took the money all the way out of the market? So if your goal was $1 million, you took it out of that $900,000 because you're worried about a bounce down, you would save the money you didn't lose in the market, so that's not too bad. But if it was just in cash or treasury bills, there would not be the gain back when there's a bounce back or a recovery. So we have to be careful. You need to work with an advisor to make sure that you didn't take everything completely out of the market. And we have some wonderful products here at Park City Investment Center, like annuities, where you're taking it out of the risk of the market, but you still get a portion of the market upside when there is a recovery in the market.
So another important to think about, update your beneficiaries. If you get married, if you have children, if you're looking to set up a trust, these are all important things to make sure that you're also leaving a legacy behind. Number 5, create a Social Security strategy.
So again, looking at this, that you have, in the green is revenues that are going into Social Security, and benefits promised are the dark blue line, and those the light blue line is a surplus, or benefits that are promised out above what is going in, and only 79% of what's going out is actually going in right now. So we do have a concern. It's the thing you've heard about, running out of money in Social Security as baby boomers retire. So there is a concern about how much to lean on Social Security. I'm hoping that, again, when I retire, I'll be getting a good share of the Social Security, but Ryan, being younger next to me, probably really isn't counting on getting too much back out of Social Security by the time he retires 40 years from now.
Maybe sooner.
So, what is your full retirement age? Again, looking at in the 1954, it would have been age 66. 1955, 66 and 2 months. 1960, 67 years old. What is the monthly benefit that you would be getting? An example here might be at age 62, $2,100 is a maximum. Going all the way out to at age 70, the maximum would be
it's in the way there. Yeah.
About $3,500. So we need to be deciding when we're taking our monies out and how much income needs to be replaced by Social Security. Again, each situation's going to be different on that.
So 6, build a retirement income stream. To pay for living expenses in retirement, you'll likely need a combination of income from Social Security as well as other income services, so other income sources, so other investments that you might have. Since there's no such thing as a retirement paycheck, let's talk about some of the ways that you can be sure that you have that income coming in.
So if your average monthly income from a $500,000 investment as of March 31st of 2020, you're sitting at, a money market account, you're going to be earning 0.2%, 1-year CDs 0.34%, bonds 0.49%, treasury bonds 0.70%, corporate bonds 3.5%, and then high yield bonds 9.67%. So this can affect that, if you're sitting at the lower earning cash accounts, you might be earning $83, a month off of this, or $142. But as you get a higher, you might have $204 off of the global bonds, $292 off of the treasury bonds, $1,400 off of corporate bonds, or $4,000 off of the high yield bonds. What are systematic withdrawals? Taking money out of the accounts, and if you're taking it out monthly, and this would be an example of off of $500,000, $1,500, it's called reverse dollar cost averaging, because it affects, as you're taking the money out, instead of all at once, you can protect taking it out at the wrong time by splitting it up over monthly withdrawals. So, turning retirement savings into retirement income. And your income can be fluctuating. So systematic withdrawals can be adding consistent income instead of just taking it out on a lump. And so there's ways to plan to distribute your money out of your original savings. We help quite a few members with retirement savings planning.
And then the last thing to look at, look beyond the money. Last thing you need to do before you retire is look beyond the money. We'll explain what this is a little more here.
So, the human happiness curve, level of happiness. Money is important. It provides an opportunity, but it isn't everything. The good news is that for many, it's going to get better. Study after study has shown that on average, as people get older, they become happier. The trend has been observed across gender, income level, education, culture, and geography. The U-curve of humans' happiness has been attributed to lower stress levels, less regret, less concern for status, and having lots of experience regulating your emotions. So research on this has come from the Journal of Consumer Research, saying as people age, they tend to savor the familiar, peaceful, ordinary events that comprise their daily lives and reflect who they are in the present. So happiness factors have to do with health, friendships, family, and going into what you love, what are you good at, what you can be paid for doing, and what are the world of needs, and basically finding a middle ground of doing all these things together. What are some things that can create a good retirement living plan? Contributing to a cause, charitable helping, visiting family and friends, pursuing hobbies, traveling, starting up your own business, or going back to school. things accomplished by people above age 65. Peter Roget invented the thesaurus after age 65. That's easy for me to say. Colonel Sanders started Kentucky Fried Chicken after the age of 65. Madonna Booter was a triathlete. Grandma Moses started painting after the age of 65 at actually age 76. And Yuichiro Miura climbed Mount Everest after age 65. Retirement is wonderful if you have two essentials, much to live on and much to live for. So again, to reiterate, 7 things that you need to do in the decade before you retire. Determine when the right time is right. And again, that's different for everybody. It should usually be after age 59 and a half, but we've seen age 62, 65, 67, 70, 72. Take aim at your retirement target and plan for that by maximizing your nest egg. Come in and get a portfolio checkup. Create a Social Security strategy. Build a retirement income stream. And this is something that differentiates us from other financial advisors. Many financial advisors are really good at growing money from a young age with all into growth stocks and mutual funds. 401ks are really good at accumulating or growing money. But we realize that in that retirement red zone or in that final stretch of the race, it's time before retirement to become a little more conservative and do some planning. So that is something we're cognizant of and have helped many members with. And then look beyond the money. Money isn't everything. You have to be able to do things that are enjoyable. Sometimes it takes money to do some of those. Work with your financial advisor. How can you do that? We meet with members, but you do not need to be a member of Park City Credit Union to meet with Ryan or myself. We do have 4 branches of Park City Credit Union here in Merrill. We have Tomahawk, we have Rhinelander, and we have Minocqua. Jeff Konechny is the 3rd member of our investment team here. He is in Minocqua helping members right now. Jeff basically covers our Minocqua and our Tomahawk branches. Ryan works in Merrill here 4 days a week, and he works in Rhinelander. Usually he's there on Wednesdays, but can be by appointment. And I oversee the other 2 and go between the 4 branches to help them out, and can by appointment also meet with people to help for overflow. So we do that. We have always been flexible, but since the pandemic has been around, we have been having phone calls with our members to calm them down and review their cases and have annual reviews with them. We also have done some of this on Zoom or on Skype or on basically on the phone with doing FaceTime. We have more capabilities to do paperwork over the internet and do some document signing and submitting things electronically. So we will be flexible, and we do make house calls also. And with that, we have our masks available all the time. So we're doing what we can do to make it as easy as it can be for you in these difficult times.
Thank you. Yep, and we'll kick it back to Lisa here after we put up our contact info. There we go.
Well, thank you, Kurt and Ryan. I said this before in our session earlier today, but I really do learn something new every time I attend one of your sessions. The human happiness curve, I'll admit, that was something I had never seen before. So it was really interesting that you brought that up. Yep. All right, so we are now to the Q&A portion of the session. We ask that if you have a question, please utilize the raise hand feature and then go ahead and unmute yourself and ask the question. Otherwise, feel free to put a message in the chat box and we will address them as they come in. And if we aren't able to address all the questions during today's session, we will personally reach out to you with an answer. So, like I said, type in any of those questions that you may have. I want to touch on something earlier that, Kurt, you talked about today. We have an election coming up. As everyone knows, we're probably all sick of the political ads and all the mailings that we see on TV. But interestingly, you said that this election will affect the market. So, and especially for folks who are nearing retirement, can you address, how this election will affect those close to retirement?
Sure, Lisa. Again, if you're in that final stretch, you wouldn't have time if you lost money to recover before you retire if you're going to be retiring very shortly. So we do have a concern that one thing that might be out there is a great example is in the state of Wisconsin. You might be able to do your ballot via mail-in, and it needs to be postmarked by Election Day, and there are 7 days that it can be allotted for the mail to get there before the counting is finished. So if we're sitting in a period of limbo without knowing who actually won the election for up to 7 days, that is something that we have seen that some of the underlying experts have conveyed out to us that they're concerned that one thing the market does not like is uncertainty. And if there's an uncertainty of who's going to be running the country during a period when there's a counting of votes, there is a high concern of volatility. So we have a little bit of a concern there's going to be a volatile market during this election time, and there might be some issues and concerns during that time. So this would be a wonderful time to come talk with a financial advisor to make sure all of your ducks are in the row. And we've had some members who have pulled a little bit of money back to a little more conservative of a holding position so that they aren't hit with a loss if there is a downturn in the market. And again, I'll put in my little plug there that a lot of people complain about what's going on. The one way to do that, whichever way you want to go, is do go out and vote. So not a bad idea.
Thanks for talking about that, Kurt. I know you talked a lot about preparing for retirement and what to do in the years prior. For folks that are in their 70s, their 80s, are you still able to help them with investments?
Yeah, absolutely. We work with people from people who are 18 years old all the way up to their 80s, even some people in their 90s. There's still planning and whatnot that you have to do when you're in your 70s and 80s. So even if you just have to come in and ask questions about a second opinion on your portfolio as it is, we are more than happy to do that. And to build off of that, it does not cost anything for you to come in and talk to us. It's a free consultation for your first time coming in, but if you have questions going forward, we're more than happy to take the time to either sit down with you or talk via phone or anything like that. We are not fee-based in that way. So.
Thank you for sharing that, Ryan. Like I said, if anybody has any questions, feel free to put them in the chat box. This has just been so informative, and I know retirement, when we talk about it, our heads can be spinning just thinking about that. So yes, thanks again for taking the time to go through it with us today. I'm not seeing any additional questions come in. I do want to mention for folks who weren't able to join us live and are watching the recorded version, if you do have some questions, Ryan and Kurt's contact information is on the screen right now. So feel free to give them a call, and they would be very happy to follow up with you. But other than that, Kurt and Ryan, anything you want to say before we say goodbye?
No, just thank you for taking the time to be with us. So, yep. Thanks,
you.
Lisa.
Yes. And on behalf of the planning team and presenters, I want to thank all the attendees for being part of our second annual Northwoods Financial Summit. As a reminder, we will send out the recordings of the sessions next week, as well as a survey for feedback. We do have one more session this week. Tomorrow we'll be talking about managing, protecting, and improving credit. So if you have questions about credit scores, it's a great session to join. To get registered for it, just go to our website. That's parkcitycu.org/summit, and then you can get signed up there. We would love to have you join us. And again, thank you for attending, and I hope everyone has a wonderful evening.